Ladies and gentlemen, $8 trillion. That's not just a number on a screen. That's more money than the entire economy of Japan, more than the GDP of Germany and France combined. And right now, every single cent of it is sitting in American assets, controlled by European investors who are watching Donald Trump slap tariffs on their exports and wondering if it's time to pull the trigger on the biggest financial retaliation in modern history. We're talking about a weapon so powerful that if Europe decides to use it, the shockwaves could make 2008 look like a warm-up act. Your retirement account, your mortgage rate, the price of everything you buy, all of it could change overnight. And here's the kicker. Most people have no idea this is even happening. So buckle up, because what I'm about to tell you is going to change how you see the global economy forever. Let's rewind for a second and talk about what just happened, because this story starts in one of the most unlikely places on Earth, Greenland. Yes, Greenland, that massive ice-covered island between North America and Europe that most people couldn't find on a map if their life depended on it. Donald Trump has been obsessed with Greenland for years. He tried to buy it during his first term, got laughed at by Denmark, and apparently never got over it. Now he's back in the White House, and he's decided to use his favorite weapon, tariffs, to put pressure on Denmark and the European Union over Greenland's strategic importance. We're talking about tariffs on Danish goods, threats of broader European trade restrictions, and a whole lot of diplomatic chaos that's making European leaders absolutely furious. But here's where it gets interesting. Trump thinks he's playing hardball. He thinks he can bully Europe into submission the same way he tried with China, Mexico, and everyone else. What he doesn't seem to realize is that Europe has been quietly building up the most devastating countermeasure in economic warfare, and they've been doing it for decades without anyone really paying attention. Those $8 trillion I mentioned? That's European money invested in American stocks, bonds, real estate, and companies. It's pension funds from Germany, insurance companies from France, sovereign wealth strategies from the Nordic countries, all deeply embedded in the American financial system. And if Europe decides to start pulling that money out, even gradually, the consequences would be absolutely catastrophic for the United States. Now, I know what you're thinking. 8 trillion sounds insane. How did Europe end up with that much money in American assets? Well, let me paint you a picture. After World War II, the United States became the safe haven for global capital. The dollar became the world's reserve currency. American markets were seen as the most stable, most liquid, most trustworthy place to park your money. For decades, European institutions, pension funds, insurance companies, and wealthy individuals have been pouring money into US Treasury bonds, buying shares in American companies, investing in New York real estate, accumulating dollar-denominated assets, because that's what you did if you wanted safety and returns. Year after year, decade after decade, that pile of money just kept growing. By the time we hit 2025, we're looking at approximately $8 trillion in European holdings of American assets. That's roughly equivalent to 40% of US GDP. Let that sink in for a moment. Now, Trump slaps tariffs on European goods over Greenland, and suddenly European leaders are sitting around mahogany tables in Brussels and Berlin asking themselves a very simple question. Why are we funding the country that's actively trying to damage our economy? And that's when things get really interesting, because Europe has options. They have so many options, it's actually scary. They could start slowly rotating out of US Treasury bonds and into European bonds, or Asian bonds, or even gold. They could begin redirecting investment capital away from Wall Street and toward European markets or emerging economies. They could impose their own retaliatory tariffs, sure, but that's old school. The real nuclear option is financial, and it doesn't require a single law to be passed. All it requires is European fund managers making slightly different allocation decisions quarter after quarter after quarter. Let me walk you through what this could look like in practice, because the mechanics of this are absolutely fascinating. Imagine a major German pension fund that currently holds $50 billion in US assets. They don't have to sell everything overnight. That would be stupid and self-destructive. Instead, they just quietly adjust their rebalancing strategy. When US bonds mature, they don't reinvest in new US bonds. They buy European bonds instead. When they need to allocate new capital from pension contributions, they overweight European stocks and underweight American ones. On paper, it looks like a normal portfolio adjustment. Nothing dramatic, nothing that sets off alarm bells. But when you multiply that behavior across hundreds of European institutional investors, all making similar small adjustments over a period of months or years, you end up with a massive capital outflow that could send US interest rates soaring, stock prices tumbling, and the dollar into a tailspin. And here's the really devious part. Europe doesn't even need to announce what they're doing. In fact, it's better if they don't. If they came out tomorrow and said, we're pulling $8 trillion out of America, markets would panic immediately, which would hurt European investors too, because they still own those assets. But if they do it quietly, strategically, without fanfare, They can maximize the damage to the US while minimizing the damage to themselves. It's financial warfare in slow motion, and it's brutally effective. Now let's talk about what's happening in the markets right now, because this isn't just theoretical. We're already seeing some very interesting movements that suggest European investors are getting nervous. US Treasury yields have been creeping up over the past few weeks, which means bond prices are falling. Normally, you'd expect yields to drop when there's global uncertainty, because investors flee to the safety of US bonds. But that's not happening. Instead, we're seeing European bond yields becoming more competitive, which suggests capital might already be starting to rotate back across the Atlantic. In the stock market, European indices have actually been outperforming American ones lately, which is unusual given how dominant US tech stocks have been. The European Stoxx 600 is up, while the S&P has been choppy and volatile. That could be a coincidence, or it could be early evidence that European money is coming home. In the commodity markets, things are getting even more interesting. Gold has been on an absolute tear, pushing past $2,700 an ounce and showing no signs of slowing down. Now, gold rallies when investors lose faith in paper currencies and traditional financial assets. The fact that gold is surging while Trump is picking trade fights with Europe is not a coincidence. Oil prices have been volatile, bouncing between $70 and $80 a barrel, as traders try to figure out whether Trump's tariffs will slow global growth or whether geopolitical tensions will restrict supply. And in crypto, Bitcoin has been swinging wildly as institutional investors try to decide whether it's a safe haven asset or just another risk-on play. We saw Bitcoin touch $90,000, then crash back to $75,000, then rally again. That kind of volatility tells you that big money doesn't know what to think right now, and when big money is confused, retail investors should be very, very careful. Speaking of retail investors, let's talk about who wins and who loses if this European financial weapon actually gets deployed. If you're a regular American with a 401k or an IRA heavily invested in US stocks and bonds, you're in the danger zone. A significant European capital outflow would put downward pressure on stock prices across the board. Tech stocks would get hammered because they're overvalued and rely on continuous capital inflows to justify their sky-high valuations. Banks would suffer because higher interest rates would squeeze their lending margins and reduce the value of their existing bond holdings. Real estate investment trusts would crater because higher borrowing costs would demolish property values. Basically, if you own mainstream American assets, you'd be looking at serious losses. On the flip side, there would be winners. Gold miners would print money as gold prices soared. Defense contractors might benefit from increased geopolitical tensions. Companies that do most of their business outside the US and earn revenue in foreign currencies would see their relative position improve. Energy companies with global operations could thrive in a chaotic environment. And here's an ironic twist. European stocks would likely outperform, which means American investors who have diversified internationally would actually be protected. The people who lose the most would be the hyper-patriotic, Buy America-only crowd who think international diversification is unpatriotic. They'd get absolutely destroyed. For banks, this is a nightmare scenario. Major U.S. banks like JP Morgan, Bank of America, and Citigroup are sitting on massive portfolios of bonds that would decline in value if interest rates spike. They're also heavily exposed to commercial real estate, which would collapse if financing costs surge. European banks, meanwhile, would face their own problems because they're also invested in U.S. assets. But they'd be better positioned because European interest rates would likely stay lower, giving them a competitive advantage. The real carnage would be in regional American banks that are already struggling with unrealized losses on their bond portfolios. If European capital flight pushes rates up another percentage point or two, we could see a wave of bank failures that makes the Silicon Valley Bank collapse look minor. Multinational corporations are in a weird position. Companies like Apple, Microsoft, and Google that earn massive revenue in Europe would face both tariff headwinds and potential regulatory retaliation from angry European governments. But companies that manufacture in Europe and sell globally, like some pharmaceutical and automotive firms, might actually benefit from a weaker dollar, making their exports more competitive. The key variable is where you manufacture, where you sell, and what currency you're denominated in. This is going to create winners and losers in ways that most investors haven't even begun to think about. Now, let me take you back in time. Because if you think this kind of economic warfare is unprecedented, you haven't been paying attention to history. Let's start with the 1970s, when gold and silver went absolutely ballistic. Back then, the US was dealing with massive inflation, a collapsing dollar, and a crisis of confidence in American economic leadership. Gold went from $35 an ounce in 1970 to over $800 by 1980. Silver went even crazier, from less than $2 to $50 in the same period. Why? Because investors around the world, including Europeans, lost faith in the dollar and fled to hard assets. The Hunt brothers famously tried to corner the silver market, but the real story was a global loss of confidence in American financial stability. Does any of this sound familiar? We've got inflation, we've got a president picking trade fights, we've got foreign investors questioning whether U.S. assets are as safe as they used to be. History doesn't repeat, but it sure as hell rhymes. Then there's the 1980s trade wars. Reagan slapped tariffs on Japanese cars and electronics because he thought Japan was eating America's lunch. Japan retaliated, not primarily with tariffs, but by threatening to pull back on their massive purchases of US Treasury bonds. Sound familiar? Eventually, both sides backed down because they realized mutual economic destruction wasn't in anyone's interest, but not before causing serious market volatility and recession fears. The lesson from the 80s is that when you start financial wars with your biggest creditors, you might technically have the bigger military, but they have the leverage where it actually hurts. Fast forward to 2008, and we saw what happens when confidence in the American financial system evaporates. European banks were heavily exposed to American mortgage-backed securities, and when those imploded, it triggered a global crisis. But here's what people forget. In the aftermath, European regulators became much more cautious about American assets. They diversified, they built up their own financial infrastructure, they reduced their dependence on Wall Street. The Europeans learned from 2008. The question is, did we? Because if European institutions decide American assets are too risky or too politically fraught, they now have alternatives that didn't exist 20 years ago. They can invest in Asian growth, they can build up European capital markets, they can diversify into commodities and alternative assets. They're not trapped anymore. And let's not forget the dot-com bubble of the late 90s and early 2000s. European investors poured money into American tech stocks during the boom, believing the hype about the new economy. When it crashed, they lost fortunes. The Nasdaq fell from over 5,000 to below 1,200. European pension funds and institutional investors got slaughtered. There's a whole generation of European fund managers who still remember that pain, and they're not eager to repeat it. Right now, American tech stocks are trading at valuations that make the dot-com bubble look reasonable. If European money starts flowing out and removes one of the key pillars supporting these insane valuations, we could see a crash that makes 2000 look gentle. So let's think about the storytelling arc here, because this isn't just about numbers and economics. This is about power, pride, and the inevitable decline of empires that get too arrogant. America has been the undisputed financial superpower since 1945. We've had the reserve currency, the deepest capital markets, the most powerful military, and the ability to project economic power anywhere on Earth. But every empire eventually overreaches. Rome did it. Britain did it. And now we're watching in real time as America picks a fight with one of its most important economic partners over a frozen island that Denmark has zero intention of selling. It would be hilarious if the stakes weren't so catastrophically high. The hidden strategies Europe could employ go way beyond just selling assets. They could coordinate with China to reduce dollar dependence in international trade. They could accelerate the development of a digital euro to compete with the dollar in global transactions. They could use regulatory power to make it harder for American companies to operate in European markets. They could impose data localization requirements that force American tech giants to build separate European infrastructure. They could weaponize environmental and labor standards to disadvantage American imports. And perhaps most devastatingly, they could simply stop buying American debt, which would force the US government to either raise interest rates dramatically to attract other buyers or print money and risk serious inflation. Every single one of these strategies is already being discussed in European policy circles. The political ramifications are absolutely staggering. If Trump's Greenland tariffs trigger a European financial retaliation that crashes the American stock market and pushes the US into recession, the political fallout would be immense. We're talking about millions of American retirement accounts losing value, unemployment rising, economic pain spreading across red and blue states alike. Trump's political base might support tariffs in theory, but they won't support them when their 401ks are down 30% and their jobs are at risk. The Democrats would have a field day, even though they'd also be scrambling to manage the crisis. Internationally, American credibility would be shattered. If we can't even manage our relationship with our closest democratic allies without triggering a financial crisis, how can anyone trust American leadership on anything? And here's a scenario that should terrify everyone. What if this spirals into an actual new Cold War, not with Russia or China, but with Europe? What if the transatlantic alliance that has been the bedrock of Western security since World War II fractures permanently? What if Europe decides it needs to build its own military capability independent of NATO because they can't trust America anymore? What if they align more closely with China on economic matters to counterbalance American aggression? We could be witnessing the end of the American century, and it's happening because of a temper tantrum over Greenland. Future historians are going to have a field day with this. But let's bring it back to you, the person watching this video right now. What should you actually do with this information? First, understand that financial markets hate uncertainty, and right now we're swimming in it. The smart money is already hedging, already diversifying, already preparing for multiple scenarios. If you're 100% invested in US stocks and bonds, you are not diversified. You are concentrated in a single geopolitical bet. Consider adding international exposure, particularly to European stocks and emerging markets. Consider adding some gold or gold mining stocks as a hedge against dollar weakness. Consider reducing exposure to the most overvalued sectors like tech and high-flying growth stocks that depend on continuous capital inflows. Second, pay attention to bond yields. If you see US Treasury yields spiking while European yields stay stable or fall, that's your early warning signal that European capital is rotating out. That's when you want to be defensive, hold more cash, maybe even short some of the most vulnerable sectors. If you see yields normalizing and stabilizing, you can breathe easier for a while. The bond market is smarter than the stock market, and it will tell you what's really happening before CNBC does. Third, don't panic, but don't be complacent either. We might muddle through this with some market volatility, but no major crisis. Trump might back down on the tariffs. Europe might decide retaliation isn't worth it, and everything might go back to normal. Or we might be at the beginning of a fundamental realignment of global capital flows that will reshape the financial world for decades. You can't know for sure, which is why you prepare for both scenarios. You diversify, you stay informed, you avoid making emotional decisions, and you remember that in times of crisis, the people who survive are the ones who saw it coming and positioned themselves accordingly. History is full of moments where everything changed, where the old rules stopped working and new realities emerged. The question is always the same: are you going to be the person who recognized what was happening and adapted? Or are you going to be the person who kept doing the same thing until it was too late? Right now, as I'm recording this, we are potentially living through one of those moments. $8 trillion is a weapon, and Europe is deciding whether to use it. The fact that most Americans don't even know this is happening doesn't make it less real. It makes it more dangerous, because the people who will be hurt the worst are the ones who never saw it coming. Think about how insane this is. We live in a world where a dispute over Greenland, a place where 50,000 people live on a giant sheet of ice, could trigger a financial crisis affecting billions of people and trillions of dollars. We live in a world where global supply chains are so interconnected that tariffs on one side of the Atlantic cause stock market crashes on the other. We live in a world where money moves at the speed of light, and a pension fund manager in Frankfurt making a portfolio allocation decision can affect your retirement account in Topeka. This is the world we've built, and now we're discovering that it's a lot more fragile than we thought. The next few months are going to be absolutely critical. We need to watch what Trump actually does versus what he threatens. We need to watch how European leaders respond, not just with words but with actions. We need to watch capital flows, bond yields, currency movements, and all the boring technical indicators that actually tell you what's happening beneath the surface. And most importantly, we need to remember that in times like these, information is power, preparation is protection, and the people who win are the ones who see around corners. So here's my challenge to you. Don't just watch this video and forget about it. Share it with everyone you know who cares about their financial future. Subscribe to this channel because I'm going to be tracking this story every single week as it develops, and you need to stay informed. Hit the like button so this video reaches more people who need to hear this message. Turn on notifications because when something major breaks, you want to know immediately, not 3 days later when it's already priced into the markets. This is the story that mainstream media isn't covering properly because it's too complex, too nuanced, and too scary. They'd rather talk about the latest political drama or celebrity gossip. But you're here because you're smarter than that. You understand that the real story is always about power and money, and right now, the power dynamics that have defined the global economy for 80 years are shifting beneath our feet. The only question is whether you're going to be prepared for what comes next. I'll see you in the next video, and until then, stay informed, stay diversified, and stay skeptical of anyone who tells you they know exactly what's going to happen, because in times like these, the only certainty is uncertainty itself.